Joining us, and all the best for the quarters to come. Well, that's right. But moving on, Adani Wilmar's Q1 earnings were strong year over year, but there's been a mild dip sequentially because of edible oil inflation, and that's, of course, hit the entire industry. To understand the price picture and the FY23 outlook, we're joined by Angshu Mallick, who's the MD and CEO at Adani Wilmar. Mr. Mallick, good morning and thanks a lot for joining us. Can you tell us what is the current edible oil prices? How much has it fallen from the top and how much have you been able to pass on?
Good morning, Sonia. Over the last 3 months, the edible oil prices have come off, and that should be in the range of around 20-25%, and almost identical value has been passed on to the consumers. I think all the companies have been able to pass on the benefits to the consumers. Going forward, we hope that the prices remain stable and further comes down with the harvest that is coming up in October onwards, and India is going to have a good soybean crop. US is also going to have a good soybean crop, so we expect the prices to calm down. So as we go, the festival season should be good.
So can you tell us what does this mean for edible oil segment itself? Your revenue growth was very strong in quarter gone by, but the EBIT, the operational performance EBIT was down about 10%. What is the expectation for the remaining quarters of the fiscal?
See, in quarter one, our volumes have grown by almost 15% over last year. Edible oil also we have grown in volume by 6%, food FMCG by 53%, and industrial essentials such as castor oil, oleochemical, we have grown by around 22% in volume terms. Value terms is 30% basically because of the inflationary trend. Now, EBITDA, when you say it has come down, it's only as a percentage, because when the value goes up, obviously there's a percentage might come down, but on absolute per ton, which we generally measure in terms of efficiency of our performance, we have been able to manage that well.
So, Mr. Mallick, what would both volume growth and margins broadly look like? Will they look up in Q2 and for the full year FY23? Can you give us some guidance?
See, going forward, Q2 volumes so far has been steady. But going forward, see, we expect the second half of the year, October onwards, the rural consumption coming back into action. We did not see a good rural consumption in Q1 as well as Q2, but after harvest, we all feel that rural India will consume more. That is one big thing. Second, our HoReCa and out-of-home consumptions is also growing. And I expect that second half of the year will see a big boom in out-of-home consumption. We have all the products which goes into out-of-home consumption in hotels, restaurants, particularly basmati rice, edible oils, wheat flour, maida, besan, and all these products are...
Mr. Mallick, but out-of-home consumption is booming as is now, right? Has been booming for a while.
Yes, it's only in the last 2-3 months that we are finding that the traction has come, and if you see across the country, people are moving out, but more will happen after October. This year, the festivals are also ahead by 15-20 days. So October should see a big month for all of us, and followed by up to Christmas, there is no looking back.
Okay. You're sitting on a strong market share, almost 19% of the market in the edible oil space. Has it gone up since the last time we spoke?
Yes, it has gone up. We did that at around 18.8. It is now 19.6. We are growing faster than the market. We will continue to do that, and that is happening because of the extensive distribution coverage that we are doing in the rural markets. And I personally believe that the rural market has great potential. Once they come back into consumption, I'm sure we will see big boom, because the prices of essential commodities such as edible oil has been high, and it has impacted per capita consumption.
Okay. I have to ask you about the food and FMCG business, because over there, your volume growth has been very strong. Q1 volumes were up 53% year on year. But now we are seeing other large players getting set to enter, right? I mean, Reliance is going to be entering the FMCG business very soon. Would that sort of skew your numbers with so much competition coming through? And what is the volume growth target that you have?
See, it is always good to have strong competition. One, we can see that the staples, which is essential, like dal, besan, rice, basmati, non-basmati, wheat flour, sugar, all these are around 8 to 10% branded. 90% is still loose. Now, in any such daily essential, if the market of loose is so high, it gives great opportunity for players like us to garner share. Now, I don't think a single player like us can change the consumption of loose to packed. There are requirement and player for at least 2, 3 big players, and I'm sure in the next 4, 5 years you will see that big players have changed the way staples is consumed in India.
So what is the target share of revenues from the non-oil business? Currently, you get about 11 to 12% of your volumes from the foods business. You had a target of 20 to 25% in the next 2 to 3 years. Do you stick with that? Do you think you can do better?
See, the food volumes are increasing. Last quarter, we grew at 53%. Obviously, the value has also gone up. However, edible oil prices are almost 5 times that of wheat flour. So even if the wheat flour volumes goes up at 53%, edible oil, even if it goes up by 5%, it takes care of all the values. So I think going forward, we will be pushing more and more volume for essentials, particularly food. And value-wise also, I am hopeful it will go up. Once the edible oil market prices comes down, obviously the share of food will look up.
Mr. Mallick, just to press on that point, with a large competitor entering full-fledged in that space now, the FMCG space, you think broadly, price-led growth maybe just from a competitive intensity standpoint, may be constrained? What is your own sense?
See, the staples business is very large in terms of volume. Edible oil is only 17 kilo per head. But when you look at wheat flour, it is 60 kilo per head. Now, out of 60 kilo, if only 10% is branded, so you have 90% open. I think there is enough scope for all of us to grow. We don't have to snatch each other's share. We only have to see how we can convert loose to packed, unbranded to branded, and make products more healthier, better in terms of value, and give doorstep service to the consumers. If we can do that, I think all the competitive brands can grow fast.
Okay. Any acquisitions on the cards? You had earmarked 500 crores for acquisitions. Anything that you've narrowed down on?
See, this part we always keep on studying. We have a team which keeps on scanning possible opportunities, and it's a continuous affair that we have been looking at. We will surely have some work on it completed by March 23. I hope so.
All right, Mr. Mallick, we'll leave it there today. Thanks a lot for joining us. That's Adani Wilmar.